Are we on the brink of a recession that could rival 2008? I've taken a deep dive into today's economic landscape, examining data from the Federal Reserve, the Bureau of Economic Analysis, and top financial institutions, and what I found is seriously concerning. In this video, I'm breaking down 5 clear warning signs that the global economy may be heading straight toward another major downturn. Each sign is more alarming than the last, and the 5th one ties everything together in a way that's hard to ignore. Stay with me through all 5 signs, because by the end, you'll see the full picture of what's happening and how we can navigate the storm ahead. Let's start with the first red flag. The economy is clearly losing momentum. Recent reports show that economic growth has slowed noticeably over the past few months. And it's not just about numbers on a screen. Industrial production is barely moving. After falling in August, it managed only a tiny 0.3% uptick in September. That's stagnation, not strength. Meanwhile, the unemployment rate has ticked up to 3.8%. That might not sound dramatic, but in a tight labor market, even a small rise means jobs are starting to disappear. On its own, this slowdown doesn't mean a crash. It could just be part of a normal cycle. But this is like the first tremor before a much bigger shake. It tells us the system is under pressure. Have you seen businesses slowing down where you live? Think about it. Sign number 2 is a classic red flag, the inverted yield curve. In October 2023, the 10-year Treasury yielded 4.8%. while the 2-year was higher at 5.0%. When short-term rates exceed long-term rates like this, it's historically predicted recessions. Think 2001, 2008, even earlier. Meanwhile, corporate bond spreads widened to 1.6% up from 1.4% in July, showing lenders are getting cautious and making it harder for businesses to borrow. Less credit means less investment and less liquidity. This is a textbook setup for a recession. It's like the economy's fuel supply is getting cut off. Number 3 hits closer to the markets. Corporate earnings, especially among major companies, have been under serious pressure. Recent figures reveal that many of the businesses in the S&P 500 have experienced a steady decline in their profits for several consecutive periods. Companies are struggling with rising costs and declining consumer demand, which are squeezing their profit margins tighter and tighter. This isn't just an accounting problem, it's a signal that the economic engines driving growth are beginning to stall. Investors are taking notice, market volatility has spiked, and the so-called fear index has reached levels well above its long-term average. In one notably difficult month, we even saw the S&P 500 slip by nearly 5%, reflecting growing uncertainty and anxiety among traders and fund managers alike. When corporate profits decline, the impact ripples throughout the entire economy. Companies facing financial strain often resort to cutting jobs and postponing investments in new projects. This, in turn, weakens consumer spending and slows down economic growth even further. If the very backbone of our market, the businesses that drive innovation, employment, and investment, starts to crumble, one must ask, what is there left to support the rest of the economic machinery? The persistent drop in earnings, coupled with increased market volatility, is a red flag. It indicates that the factors sustaining growth are faltering, which may contribute to an economic downturn if this trend continues. Sign 4 takes us into the danger zone. Financial markets are showing real signs of stress. Liquidity is drying up, which is just a fancy way of saying that money isn't flowing as freely through the system. One telling stat, the bid-ask spreads on S&P 500 stocks, basically the gap between what buyers want to pay and sellers want to get, widened from 0.03% in June to 0.05% by October. That may seem small, but in the world of high-frequency trading, that's a red flag. It means it's getting harder and more expensive to trade, even for the big players. At the same time, corporate defaults are rising fast, hitting 3.2% in September, and margin debt is hovering around $800 billion, near all-time highs. That's borrowed money used to gamble in the markets. If prices fall suddenly, we could see forced liquidations across the board. It's not just the average person pulling out of the market. Big institutions are feeling the heat. Hedge funds, banks, asset managers, they're all being squeezed by tightening conditions. When markets lack liquidity, they become fragile, brittle, like glass. One sharp shock, whether it's a major bankruptcy, a geopolitical crisis, or a sudden interest rate move, could set off a chain reaction. We saw this in 2008, when interbank lending froze and panic spiraled out of control. We're not there yet, but we're seeing the same early fractures. In today's hyper-connected financial world, no market exists in isolation. Recent data shows the correlation between US equities and global bonds has surged to 0.6, up significantly from just 0.4 earlier in the year. That may sound technical, but here's what it really means. If one market crashes, others are far more likely to follow. The barriers that once kept financial crises from spreading are now barely holding. And global trade, the lifeblood of the international economy, is weakening. It's expected to grow just 0.8% this year, a sharp drop from 2.7% in 2022. That signals fading demand on a worldwide scale. When countries aren't buying or selling, supply chains weaken, companies stall, and economies falter together. But here's what's truly dangerous. If a major financial institution fails, or if a country defaults on its debt, that could trigger a domino effect, one that spirals fast across continents. This is exactly how the 2008 financial crisis spread like wildfire. We aren't just vulnerable, we're exposed, severely. This isn't fear-mongering. This is pattern recognition. Economic growth is grinding down. The inverted yield curve is sounding the alarm. Corporate profits are shrinking. Financial stress is choking market liquidity. And now, global vulnerabilities are pulling everything together into a dangerous, highly combustible mix. This isn't just a bunch of disconnected red flags, it's a coordinated warning. And if we don't pay attention, the next shock could be the one that sets it all off. What do you think? Are you seeing these signs where you are? Maybe in your job, your investments, your community? Drop your thoughts in the comments. I read everyone. If this breakdown opened your eyes, hit that subscribe button and tap the bell. I'm posting more deep dives like this to keep you ahead of the curve. I've linked all the data sources in the description below. Here's the kicker. We're not just facing a recession, we're facing a test. The choices we make now, from policymakers to everyday people, will decide if we dodge this bullet or relive 2008. Stay sharp, stay ready.